and welcome to the Help My Wealth podcast, Money Rules or Money Rules. Here at Help My Wealth, we are all about empowering financial success in our community of listeners. We hope you find today's topic both informative and helpful. Hi, welcome back to the Help My Wealth podcast, Money Rules, Money Rules. I'm your host, Stephen Logan, and with me today, as always, is Hamish Ferguson. Hamish, thank you for coming.
No problems at all.
And today, our special guest is Dr. Mardy Chiah. Chiah, how are you?
Yep, I'm good. Thanks for having me here.
No problems at all. Dr. Mardy Chiah is the Associate Professor of Finance at the University of Newcastle and is currently the Academic Director of the Tax Clinic for the University of Newcastle. The Tax Clinic provides pro bono tax advice and services for the underrepresented and disadvantaged individuals and small business taxpayers in the Hunter region. Mardy has authored over 20 articles in research in the area of finances and related subjects. So Mardy, thank you so much for coming today.
Yep.
So today we want to talk about some of the researches that you've done, particularly in regards to trading, Finfluences, and the propensity of gambling in Australia. That's a bit of a mouthful, isn't it?
Yes, it is.
But it sounds like it's a bit of a passion for you. You've done quite a lot of research in regards to those sort of areas.
Yes, so I guess my passion in finance begins ever since I was doing a Bachelor of Commerce back at Monash in Melbourne. So I was always interested in, the financial markets and especially investment in the stock market. So which is why I proceeded to do honors and PhD in finance. So my PhD topic is about stock market investment. So whereby I actually look at why some stocks tend to generate high returns and why some tend to generate a low return. So is there a rational or a risk-based reason on why that is the case? Because in finance, we always tell, our students that there's a high risk, high return relationship, but we know that in practice, that is not always the case, whereby people are not always rational, right? So this is why instead of having a rational-based reason that causes these cross-sectional differences in stock returns, there might be a behavioral reason behind people's, people's action. Right, so this also motivated why I actually look at trading behavior of investors. So what motivated investors to trade? Right, so is it because of influence from other people, or is it because they're actually using it as a substitute for something else? Right, so the examination of those patterns in stock returns and the mechanism behind it is what always interested me.
And so so obviously it sounded like your interest started with stocks and stock returns and the stock market, and then it moved into the areas of gambling and the propensity of gambling in Australia and in other places. Do you find there's a correlation between the two, that some people who use the stock market and some people who do gambling have a similar sort of view and outlook?
Yes, so I guess in terms of academic research, so there's always this, common understanding that we have some, of course, all investors are different, right? So there'll be more professional and more rational, and there'll be some section that we call gambler investor that actually use stock market as a way to, in a way, take a punt.
Yes.
Right. So of course, right. So there's this correlation between those subgroup of investors. Right, so between their gambling propensity and how often they trade in the share market. Yes. And there are some stocks that tend to attract the attention of those gambler investors more. Yep. Right? And those stocks tend to have, greater volatility, and there are a greater chance of having a big one-day positive or negative return, because that seems to be close to gambling behaviors.
Yeah. So look, I wanted to start by, starting with the gambling and talking about that. I mean, I was always assumed that Australia had a large gambling, habit or culture, but I was quite surprised to find that compared to the rest of the world, we're actually quite high up there. Where does Australia sort of sit in regards to gambling and gambling habits, like per population?
Yeah, so that's a really good question, because if we think about the Australian population, right, so it's quite small relative to other big countries like the United States or China, but on a per person or a per capita basis, we are actually the nation with the greatest gambling behavior. Right, so a statistics from the Queensland Statistician Office actually shows that on a yearly basis, Australians gambled over $200 million on various gambling related activities like casinos, gaming, and online platforms. And we actually lost over $20 billion. Right. So if we actually translate that into a per person basis, it means that on average, Australians lost over $1,300 per person. Per person on average. Right. So this is actually ranked the first among all the nations. So if we look at some comparative statistics from other countries, they would not. So they actually did not lose that much on a per capita basis, even though the aggregate level is higher because they are a much greater or bigger nation.
Yeah, I mean, I think when I was reading your researchers, two statistics that stood out to me more than anything else, which sort of blew me away a little bit, is that we currently have 20% of the world's poker machines. That's a huge percentage, particularly when you realise that Australian population is only 0.33% of the world's population. That's a big difference, isn't it?
Yes, exactly. So it shows, I guess, in a way, the prevalence of gambling among Australians on how it is so widely accepted.
And I think also we just see it as normal because it's everywhere, do you know? Another statistic that you have that I was surprised by, and I probably shouldn't have been surprised by what it was, is that 65% of Australians actually see gambling as recreational, that it's actually a hobby, it's a sport, it's one of those, it falls into those sort of areas.
So that's right. So I guess it probably also correlates with how we are also passionate about our sports in Australia.
Yes.
So we all watch like Australian football rules, Australian rule football, rugby, and even tennis at the Australian Open, for example. So there's probably a correlation between those events and also gambling. It's because I guess when you're out with your mates, right? So we all want to take a part and also enjoy those events together.
It is interesting though when you think about it. Like, and look, please, hear that I'm not trying to promote gambling here, but when you think about $1,300 a year, right? So, if you just said, okay, is it okay to put that level of time and come out $1,300 worse off? All right. So, I mean, there'd be lots of things that the average family would spend on a regular basis that would come to $1,300 a year. All right. So it is interesting in the sense that, how does this become normalised? Well, it's probably ways of explaining it like that. Well, $1,300, that's all right. If I'm only losing that amount of money, right? But of course, there'd be a lot of people on a huge amount of money that they're losing.
That's it. It's the average, isn't it? So there's people that are losing thousands upon thousands of dollars,
Yes.
I mean, I didn't see this in the data, but you might know something. Is there any statistics that talk about the percentage of Australians that actually do gamble?
Yeah, so I guess we don't have that statistic in a way, but I guess as Steve mentioned earlier, that about 65% of Australians actually consider gambling as recreational activities. So at least 65 of us would have gambled.
At least 65% are saying that's one of my recreational activities.
Right.
Yes.
Yeah.
So there's probably another 10 or 15% out there that go, I gamble every now and then, but it's not a hobby.
It's what I do professionally.
That's what I do professionally. Yeah, that's right. And look, one of the things I wanted to ask, I guess that the question that most gamblers and people that gamble will say is, look, we all know that people lose, but I win more than I lose. How does that sort of, from a statistical point of view work? Are there people that win, really well in gambling compared to others? Is there a whole lot of losers and a couple of winners? Or does it tend to be that most people that gamble, the house always wins, that most people do tend up losing over the long run?
Yeah, so I guess so that's a really great question because there'll be like this misperception or conception that, so if I saw someone winning big bucks on a given night, I could do it. Right? So it could happen to me. But from a statistics perspective, so we have this law called the law of large number, meaning that if you go over and over and over again, back to gambling, so the house always win because gambling do have a negative payoff. Right? So it could be the case that you get lucky in one particular night. But if you do it over and over again for over the next year or two, then of course the statistics is actually biased against you, whereby the house have a positive payoff of winning money from you, whereas you have a negative expected payoff from gambling.
I know that my grandparents on my mother's side used to gamble quite a lot, and my mother was a bit against gambling because of that. I remember when I turned 18, she said to me, if you ever do gamble, as soon as if you put your $10 into your pokey or $10, wherever you're doing it, as soon as you win the money back, you've got to put it back in your pocket. You've got to win back what you've lost, and then you can only gamble what you've won.
Yep.
And it wasn't long before I realised that I never came away very often with more than what I would put my $10 back in my pocket or my $50 back in my pocket, but I didn't often go home with $100.
Yes.
I would often go home with the 50 because I actually put it away. Do you know what I mean? Yeah. But I would always come back break even. Do you know? So it's very rare that you actually end up with the large win. But when you do get the large win, you remember it, don't you?
Yes, that's right. And then you're going to tell everyone that which creates this, I guess, bias statistics about how easy it is to win from gambling.
Yeah.
Yeah, my story about gambling is that I remember being, guessing I was underage, but I'm not sure if I should be admitting that. But and it was on a horse. All right, so it was horse racing, and I remember there was one point where.
Hang on, were you riding the horse or you betting on the horse?
No, that's right. And I remember wanting to gamble on a horse, and this other guy that was in the TAB or wherever it was went, no, don't go with that one, go with this one. All right. And so I changed my mind at the last minute and went for the horse that this guy had recommended because he had all the right reasons. And then my horse won. Right. And it was, one of those 25 to 1s and all the rest of it. And I got so angry. The emotion really was overboiling. I walked out and I never gambled again. I never gambled because just the emotion that I felt at that point in time, it was unsustainable. I just couldn't get my head around it. So that was it.
I wonder what the story would be if you had said no to him and gone for the 20 to 1 odds with the horse. And, and your story here is like the first time I gambled at 17, I walked away with $2,000.
Well, that's right. Except that probably would have been the beginning of the end because I probably would have. Maybe I would have become addicted. Maybe, that would have been something that I just kept putting more and more and money into. But losing that, whatever it was, $20 or on a horse was just enough for me to go, no, I can't do this. I don't have the I don't know, the stamina, the emotion, control, whatever it was.
I mean, I think the thing that's interesting to point out with the recreation thing is that I've got some friends that are involved quite heavily in sport, betting on sports, and they do a lot of research, a lot of time and a lot of energy, and they're part of clubs and they talk to people. It really is for them quite a social activity. So from their point of view, I could see why they would see it as recreation because it's a hobby for them. You know, they know all the statistics of which football players have going to score, who's going to this, who's done that, who's done tries, where they're at, whether they're fit, whether they're not fit, and so they feel like they have a good understanding of the game. So when they're putting their money down, there's actually some knowledge and research behind it. So from their point of view, it would be quite a recreational social activity, just sometimes with a high dollar figure. So I guess in the end it's about actually setting yourself that budget, isn't it? And saying, if I see it as recreational, as I see it as social, if I see it as being fun, I don't spend more than X amount of dollars per week or X amount of dollars per month.
Yes, exactly. So it's like when you do your budgeting, right? So you're going to put this money aside for your, hobbies. So it could be, let's say, going to a holiday, or it could be, let's say, on gambling. So as long as you don't overstress yourself and put yourself in a difficult financial position, so I guess it's fine as long as you can afford to pay for it.
And I think it's something I've come across with some of the clients that I've done in regards to their budgeting that do gamble. They sort of say, look, I don't want to spend more than $100 a week, or I don't want to spend more than X amount of money. And it actually, because we use that data feed where we actually get live data from their bank account, so we know exactly what they're spending. Even if they're putting it out in cash in the ATM, you can say, hey, what was that $100 for? And they've got to say either it was for gambling or it was for eating McDonald's, but it probably wasn't for purchasing something. It's beneficial. So it allows them to actually see what they're spending. And I think that's one of the main things when it comes to just cash flow and budgeting in general, but particularly in gambling, is to be able to go, I'm happy with that level of $100 a week or whatever it is. It's when you start going over it and you see that you've done $200 or $300 or $400 that week, that's when you go, okay, I need to pull myself back and make it more of an effective, budgeting strategy here.
Yeah.
So if I can go backwards a step, Marty, so, I guess in Australia we have this probably phrase that, when it comes to the stock market that, I'll get a lot of people come in that might be more comfortable with property or they might have never invested and they'll go, investing in the stock market is just like gambling. All right. So where did that sort of connection come from? So obviously you've got a finance background, you studied this, right? And then all of a sudden, one day, some pennies dropped or somebody said something to you that made you start thinking about this concept of stock market and gambling. Do you remember how that connection came about?
So this probably happened a lot more in recent years when the COVID-19 pandemic started.
Mm-hmm.
So I do remember back then, so in early 2000, so I think we have this lockdown from from March 2020. So I actually started getting phone call and messages from friends and relatives that I don't really know them well. And then they actually started asking me about share investment.
So like he must know what he's doing.
Yeah, so because I'm an academic or an associate professor of finance, so I started getting all these questions about, hey, is this a good stock or how should I invest in the share market?
Now you know how a doctor feels.
Yes,
when they get all these relatives from far away going, I've got a lump on my leg.
Steve, just a reminder, he is a doctor.
That's true. Just, but not a medical doctor, different.
Yes.
So they still called him, but for financial problems,
That's
not
right.
medical problems.
That's right.
Yes, that's right. So this is when I started to, I guess, realize that, okay, so there's probably a correlation between lockdown or COVID pandemic with people actually starting to take more risk than what they would usually be comfortable with, because many of these people have no prior experience investing in the share market at all, and they actually don't engage or don't seek professional advice, and they're hoping to get some free advices off me. So on how to, I guess, invest in the share market, which in fact is actually not the right thing for me to do, because in order to be providing financial advice, I need to be licensed in a way, which I'm not. Right. So that's why I guess I'm trying to do the right thing, and then I was trying to guide them to the correct resources that actually do have the license to provide those advices. So it's more about an information session from me rather than an advice session.
Did you have like a form at the front of your house where everyone had to sign to say, I did not receive financial advice from, Dr. Mardy Chiah?
No, so I trust that they won't, I guess, betray me in a way. So, but I do tell them that, you probably need to get a professional financial advice, because this is not something that I would be able to do on your behalf. And then, of course, you're going to say that if you win, the winnings or the gains belong to you.
Yes.
If you do lose money, you're going to come back to me and seek compensation.
Totally. So, that research was fascinating research when you were correlating the COVID-19 and lockdown and what happened with gambling. So, for those of our listeners that haven't read the research, you started to notice that obviously as lockdown happened, the horses stopped running, the dogs stopped running, people stopped playing sport. All of a sudden, all these avenues where people were able to bet and do gambling were no longer available. They couldn't go down to their pub for the local pokies. They were unable to go down to the casino to do that. They're sitting at home, and all of a sudden you notice that there was an increase in I think you called it residential
retail trading volume.
Yeah, retail trading, which was non-professionals coming into the market and for the first time dipping their toe into the share market and really changing up the liquidity in that market.
Yep.
So talk us through, where did that sort of come from? How did that sort of start?
Yeah, so as well as what I was saying earlier, so I started getting phone calls and messages from people that I don't really know well. So this is why I'm interested to, I guess, examine this empirically in a more formal way about why people actually started to at least show some interest in investing in the share market.
Yep.
So you're probably right that because of COVID-19 pandemic, it actually creates a huge shock to how we usually live and I guess I spend all days. Right. So in the past, right, so we're just, I guess, if you have an office job, you're going to go from 9 to 5, Mondays to Fridays. And that's also the time when the Australian stock market is opening. So you probably don't have time to trade in your office unless you want to be fired by your boss in a way. So, but because of the COVID-19 lockdown, people are actually starting to work remotely from home. So this actually created the increase in free time, or the time where they are unmonitored in a way by the bosses, which they can then potentially do some additional, I guess, potentially get some additional income through trading in the share market. So it's also right that during those periods, especially in the state of Victoria, where I was there, right? So during the lockdowns, right? So the lockdown is actually really harsh back then. So this is why people actually potentially turn to the share market as a different form of gambling that can be performed from home. And by my research do show that during the COVID lockdown periods, right, so if we actually classify the trading volumes into institutional and retail trading volume, right, so we would imagine that on average, right, so there'll be more professionals out there, so which is the case before the COVID pandemic. There are more institutional trading volumes right before COVID. But what's really surprising is that since the COVID-19 pandemic in 2020, right, so the volume of retail trading actually overtook those of institutional investor, which is surprising.
And the institutional investing, the professional investor, they didn't drop their volume. It just all of a sudden, they kept their similar sort of volume, but this retail volume, this the average mum and dad, all of a sudden has increased, the volume that's actually coming into the share market.
Yes, exactly. So on top of my head, so I can't remember the exact numbers, but I believe that from my paper, right, so the institutional trading volume did increase by about 10 to 20% from memory, but the retail volume actually increased by more than 60%, which is really substantial.
So, Mardy, like in regards to that as a statistic, what was the volume of that,
Yeah, so in my paper, I showed that before the COVID pandemic, so on average, right, so on a daily basis, about 1.5 million shares change hand by retail investors. But during COVID, so during the lockdown, so this number actually increased by more than twice. So actually over 3 million shares actually change hand on every day because of the increase in retail trading volume. So again, it actually shows that due to the lockdown for various reasons, right? So retail investors actually started trading way more than what they usually do before the pandemic.
Yeah. And do you think that trend has continued, or was it just a COVID thing and it stopped, or do you think, no, it's here to stay now?
Yeah, so I guess what I do believe is that this trend, so this abnormally high trading volume by retail investors is not going to stay because now people are not locked away in their house, right? So they probably want to go out way more than what they used to do during the COVID lockdown, right? So it's not expected to continue, and I do believe that as after the lift of the restriction, trading volume has returned back to a level that's more comparable to the pre-COVID-19 periods. Having said that, right, so there are actually about 435,000 people or investors who entered the share market for the first time during the pandemic, right? So some of these people would probably stay because now they have actually, I guess, get some taste of what it means to invest, and they've gained some additional financial literacy as well through that, right? So even though trading volume would probably return to a more reasonable level because it is indeed abnormal during COVID period, but there'll be more investors out there who have already have some form of trading experience.
And I think to add to that, I don't know if you've got any thoughts on this, Mardy, but you've talked about time being a reason why people invested and just having too much time. But from memory, I think the savings rate, because of how much money the government injected into society, people had more money than they've had since, I think it's the 1970s in terms of the savings rate. So, and given where we are now from an interest rate and cost of living perspective and that sort of thing, I'm guessing there's just naturally the economic times have cleaned a lot of people out from that in terms of who's still in there and who's not.
Their disposable income type thing.
Well, disposable income. So it's a time thing. It's a disposable income thing, but it's also like the 12 months that we've just had in the stock market weren't great.
Yeah.
Right. So if you weren't really serious at developing a stock market strategy, right, you've probably gone, oh, that's a bit ugly. I'm not going back there again.
It hurts. It hurt a lot of people.
So yeah, any sort of thoughts on that, Marty?
Yeah, so Hamish, you actually raised a number of good potential reasons on why people actually started to trade a lot more during the lockdown. First, right, so there's various stimulus provided by the government, and then at the same time, the cash rate was at 0.1%, meaning that people are not getting that much interest if they just choose to save their money in a term deposit, right? So this is why people actually started to seek alternative places whereby they could potentially generate a greater return. Right. And then, right, so during COVID pandemic, of course, we have experienced a huge decrease in share market. So back in March, for example, share market on ASX actually decreased by 50%. Right. So this actually creates, I guess, opportunity for investors to bargain hunt. Right. So back then, you could probably just invest in any given stocks during that year of 2020, and you would have made some decent returns in that given year, right? So which is also what motivated investors to trade. Of course, as Hamish just mentioned, right? So if you actually started trading, let's say from last year to now, right? So you probably will be spooked by the share market because it's not really doing that well because of high interest rate, right? So because of high interest rate and other factors. And due to the high interest rate, people are also starting to put their money in term deposit because they'll be more satisfied with that saving rates now compared to during COVID.
And so were a lot of people, was it mainly intraday trading or was it, buy and hold?
So from my experience, again, from friends and relatives who asked me those questions during COVID-19, so they probably don't know too much about share market to the extent that it's a long-term investment game. So those who entered at those time probably think of the share market as a get-rich-quick scheme, whereby they can get in and out quickly and earn, let's say, over 50% return over a short period. But we know that this is not how the share market works, right? So if we look at the statistics on the share market over a long period of, let's say, the past 20 or 30 years, share market on ASX on average generated a return of, let's say, somewhere between 8 to 12%, right? So this is why the COVID period also created this unrealistic expectation for new investors that they could actually generate huge return over a short period of time.
And was most of the volume, could you see from your brochures that a lot of that retail volume was coming in and out, or, was it staying in the market?
Yeah, so there's a greater turnover in the retail trading, meaning that people actually started to change hands in terms of that shares at a much quicker rate compared to before. So it did show, so my research did show that the turnover has increased during the COVID period, meaning that there's actually more intraday or daily trading activities going on during the COVID period compared to before.
And I'm not sure, when your research stopped or what you've been looking at statistic-wise since then, but has that, once lockdown finished, once everything turned back to normal, once life started, once the share market started to tank, in 2022,
Can we use the word correct rather than
sorry?
All right,
sorry. Once the share market started to correct in 2022, have we seen a reduction? Has it sort of gone back to what it was before?
Yes, so it has definitely. So trading volume has returned to a level that's more comparable to pre-COVID period.
Yeah.
And it's interesting, and please tell me if you think I'm wrong here, Marty, but, I think the word correct is, I'm not just being, I was being cheeky, but, in terms of, because what I've really learned out of this report as well is that, so 2021 and 2020 was a pretty good year for the stock market, but it was what I'm now starting to think is, okay, so it was good for some good reasons and some real reasons, but there was possibly this artificial stimulation in the stock market that actually pushed the market higher than might would have
Yep.
normally done, because this wasn't just an Australian phenomenon, was it? It was a worldwide phenomenon in some ways.
Yes. So you're right. So this phenomenon of increased retail attention in share market probably originated from the US, from the Robinhood trading platform.
Yes.
So whereby there's just increase in retail trading volume in the US that actually translate into other countries as well, like Australia. So this also, I guess, this is also related to the prominence of those online trading platforms that is similar to Robinhood, whereby I'm not sure whether you have seen some of those platforms before. They do look like a gambling platform or a poker machine, where everything is really colorful and everything is about based on visualization.
Yes.
So that's why it actually, I guess, encourages people to trade, because it's so easy to click the buy button or a sell button through those platforms.
And in regards to crypto, so your research didn't specifically look at crypto; it was specifically looking at the share market. But during that time, crypto went through the roof. It went crazy during that time, didn't it? I mean, but before COVID, there wasn't a lot of talk about it. If someone talked about crypto, they were really into it. Do you know what I mean? It was a passion for them. It was their hobby. It was their what they did. Whereas through COVID, everything changed, didn't it?
Yeah, so I guess so you actually make a really good point that that I also want to bring back to Hamish's earlier point about the artificial stimulus provided by government at that time. So people have a lot of money, but the saving rate or the cash rate is really low at that time, right? So in finance, we always know that there's this inverse relationship between price and interest rate. So when interest rate decreases, prices would increase. So there's always this inverse relationship that we know already. And we know that, back in 2020, right, so cash rate was at 0.1%, which in theory, and which it also works in practice, it actually pushes up the prices of various risky assets, including share market and crypto market, because those assets are the ones that's also sensitive to economic conditions.
Yes.
So when things go well, right, so those assets will actually increase in value way more, right? But when things don't go well, as what we're seeing now, so there'll be a correction or I guess a reduction in share price, because now interest rate has increased to a level that's, I guess, more comparable to the traditional level, even though it's higher than average now.
And this is, you talk about 2020, but in terms of just generally for the audience, if we think on a global scale, then money's moving all over the world based on which countries are offering better exchange rates and which markets seem to be cheap versus expensive and things like that. So would I be right in saying that it's new for this to be a retail phenomenon, but from a wholesale phenomenon, sort of moving around the money it's been around for a while. But this you're right. There's this concept of saying, well, what is a reasonable return for the current market is really, I guess, to me, what you're saying as well, and this is a bit of a penny drop moment for me, is sort of going, well, okay, so from a risk return point of view, which is something that you talked about before, there's these long-term averages, and whenever markets are behaving that's unusual, right, you really have to ask yourself the question why, all right? Yep. So because generally there's something going on that the average person can't see. Would you agree with that?
Yeah, so you're right. So I guess it goes back to, I guess, the importance of, I guess, doing research and understanding the long-term, I guess, trend of what you get yourself into, right? So earlier I've mentioned about retail investors back in 2020 having this unrealistic expectation of getting rich in a really short period of time. We know that that's not the case, and that's what institutional investors also know. So this is why the increase in trading volume is actually more, normal for institutional investors compared to retail traders, whereby they all just started to pump or put more money in the share market due to, I guess, the unrealistic expectation about returns. And of course, right, so those investors are probably the category that is also not familiar with the risk and return trade-off, Right? So if you get a really good return in a given year, probably, so if we think about the long-term average, it's probably going to be closer to average over a longer term period.
Sorry, Marty, I know Steve asked a question about cryptocurrency before and just how that fitted in. So I think I stole you away for a little while. So did we cover off on that question, Steve?
Yeah, I think we did. But I mean, look, I found the phenomenon of cryptocurrency quite interesting over that period of time. I mean, everybody was talking about it. I mean, goodness me, I think my parents even brought it up in a subject. I didn't even know they knew what it was, let alone to ask a question about it. And so many people were getting involved. And I think that leads me to my next question in regards to Finfluencers. So all of a sudden around COVID, we had these Finfluencers that had been there before, but they really came to the forefront during that period of time. How much did Finfluencers affect, the stock market, affect the crypto market, affect the property market? I mean, where did they sort of come into?
Yeah, so that's actually a survey conducted back in 2021 by I believe don't hold me to that. I believe this is a survey conducted by ASIC that shows that during 2021, right? So about 28% of young people followed at least a Finfluencer. And out of those people who at least follow a Finfluencer, 65% of them, so about 2/3 of them actually changed their financial behaviors. So this actually shows that so young people's trading or financial behaviors did change because of these Finfluencers. So they started, for example, investing, or they started following the advice or information given by those Finfluencers in relation to their investment or, I guess, spending habit.
So almost 1 in 5 young people change their behaviours.
Yes.
Because of Finfluencers.
So 28%, so about, let's say 1/3, close to 1/3, followed a Finfluencer during that period, and 65, so 2/3 of them changed their financial behaviors as a result.
And, as time went on, we started to realise that, a lot of influencers weren't just, they weren't professionals. So they were just sprouting information they picked up or what they thought wasn't actually, professional advice, was firstly. But secondly, it turned out a lot of them were actually being paid to give this advice to actually support other industries as well.
Yeah, so exactly. So I guess in a way, there's no free lunch. So there must be a reason or a motive on why influencers or people will started giving advice for free on the internet through social media platform like TikTok or Instagram, right? So there are two, I guess, widely accepted reasons on why they might want to do that. First, as you mentioned, Steve, so it's about, I guess, getting those additional collaboration opportunities like sponsored content or speaking events or even the chance to write a book, right? And another reason is that they might actually engage in this behavior called pump and dump. Right, so whereby they encourage their followers to purchase shares that they have personal interest in.
Yes.
Right, so this actually inflated the share price because with greater demand, right, so share price would increase, right, so which they would then profit at the expense of those followers. Right, so I guess it's really important for, I guess, followers or young people to also understand their motive and, of course, the background. Whether they have a related background is also important, right? So at the same time, it is important for us to know that there must be some reasons on why people are giving financial advice for free at that time, right? So it's probably so those influencers are probably not telling you the entire truth about how they succeeded, unless they are also giving you advice on how they succeeded as a influencer. Right.
And look, I think there's lots of stories where, sort of that pump and dump idea, particularly with crypto.
Yeah.
They'd buy coins quite low. They would then, get out there and really push that coin. They would watch it go up to the high. They would then get out.
Yep.
And then they'd stop promoting it.
Yes.
And it wasn't long before it would actually just dump and tank after that. Sorry, correct.
Oh no! When it comes to crypto, you can use dump. Right?
Oh, can I use dump and tank for crypto? Right. Okay, hang on. There's some bias coming coming
Yeah,
out
a little bit of bias. Yes, that's what I'm saying.
Yeah, so maybe those influencers should be actually giving advice on how to be a successful influencers.
Yes, that's right. Rather than on crypto markets.
Yeah.
So look, Hamish, from your point of view, you've got a financial background. You've had to do lots of study to be able to have a financial license, and there's a lot that you have to do to regulations wise to be able to give financial advice. Can you help our listeners understand what happened there with Finfluencers who literally had no background, no professional, were some were doing this pump and dump, and some were being paid by third parties to encourage behaviour. The government corrected that. So can you just talk us through how that happened?
Yeah, well, I guess so. Essentially, after the Royal Commission, it created a vacuum in the marketplace. So there was a lot of people that were giving advice that were, I guess, maybe not removed is the right word, but ended up exiting the industry for a variety of reasons. And so the problem is that people still wanted to get guidance from somewhere. Okay, so if I can't go to an advisor, if I can't go here, if I can't go there, naturally, most of us these days will start looking on the internet for some sort of solution. All right. So, and obviously these guys, or people, started going, well, there's an opportunity here. There's an opportunity to fill this void. And I'm sure that there were some people, and I know one podcast in particular where there's a young guy who it feels like his motives are good. Like he's actually trying to say, this is ridiculous. There's no one out there to give advice anymore. I'm going to do my best to provide support to people that are looking for guidance. And look, one of the best known books that's probably been around the last 5 years has been, and maybe even longer than that, is The Barefoot Investor, which is, again, it's something that has been incredibly successful because of, how it was promoted and that sort of thing. And there's, the guy that wrote that book, Scott Pape, I've typically said to people, look, 70 to 80% of the content in there is good. You just have to be careful because, again, it's general. It's not, specifically for your circumstances. So this vacuum got created. And then obviously, ASIC comes along and sort of goes, oh, wait a second, we've got a problem here, all right? So, and they've then tried to sort of say, well, wait a second, we need to stamp this out because the principle of giving advice, like Mardy mentioned before, is that you've got to have insurance, you've got to have the right qualifications, there's got to be structure to this because it's the lack of structure in the past that's gone horribly wrong.
And I think actually that's really important to stop and note. Here is someone who's got a doctorate in finances and in financial accounting and so forth, and he's going, I'm not a financial advisor and I can't give financial advice. There's good reasons why the government has allocated certain people to be able to do that. They have the right licenses, the right insurance, the right ability, to go from there.
Oh, and look, the reality is, in respect to yourself and the journey you've been on from an education point of view, I think if we stack the letters up next to our name, Mardy would have more letters next to his name than what I do. All right, so
to start off with, he has a D and an R.
Right, that's right. But I think if we sat down and talked about the education that we've had, there's been a difference. I think you used the word academic in the past, Mardy. So the research, the analysis, that skill that you've developed over time, is different. Whereas the skill that I've been encouraged to go on or have gone on is trying to take some of that information, but then blend the relational skills and the human psychology that actually comes with it. So, it's, in all honesty, I've been eyeing off Mardy saying, I wonder if I can afford to get him in the business, probably can't, but, so coming back to the question though, so obviously, ASIC's come in and said, we've got this bias, we've got this problem that's occurring. How do we stamp this out? And how do we bring back this structure that we've been trying to enforce really since the Royal Commission? And Finfluences, just like a lot of careers, it's you might say, I know how a loan works. I know how an offset account works. I know how the stock market works. But unless you apply all of the bits and pieces that we've had to go through to bring together this service that you call it, and it's dangerous to try and do it without the right skill set. And it's such an important part of society is to manage money, right? It's on everybody's fingertips, like, on the tip of our tongue, like, how do we make sure people retire well? How do we make sure that if we earn $1, we get to keep that money and we put it in the right way? And there is a lot of competition that fights against that.
So let's go through. So Royal Commission, what year was that?
2018.
So 2018, Royal Commission comes in and says, okay, if you want to be a financial advisor, this is now the level of financial advice you have to give, because there's been too many people out there taking money and not giving good advice or not enough advice. And so they make a standard and they say, right, you have to attain that standard. So all of a sudden in the financial market or financial advice market, lots of people leave because they go, I just can't run a business that way. Do you know? Those that stay are saying, right, to be able to give you financial advice, I now need to charge $6,000 minimum type thing.
Yeah, you could probably drop it a little bit, but it's become a lot more expensive.
It's become a lot more expensive. And so there's all these people left that aren't ready for that level of advice. They've lost the smaller advice or the more general advice that's at a cheaper level. And that's created this power vacuum where Finfluence has been able to come in and say, hey, I can actually help you do that. And so here we are now, 5 years later from the Royal Commission, or 5 years later from the Royal Commission, and the government has only just recently said, hey, we've lost a large percentage of our financial advisors. Financial advice is now really expensive. While we feel like we've created a really robust industry, we've actually destroyed it in certain ways as well. Do you know what I mean? The level of advice is great, the professionalism is great, but the access is dismal. And so I think I just read an article just recently that the Albanese government is actually saying, right, we need to actually encourage new financial advisors. We need to work out new rules so that financial advisors don't have to, be at a certain level to charge that amount of money. They actually can, legally talk in more general terms with people. So how do you think that's going to change your industry?
Look, I think it's still on a trajectory that's good, right? Because I think, you talk about, and this is going to sound like a weird example, but, people post World War II, for 20 or 30 years, everyone just probably thought about World War II. Like they just didn't want to go back to that time. So I can tell you right now that the Royal Commission and the last 5 years has been scarred into everyone in the financial services industry's brains. Right? There's just no going back to where we were because of the journey. I mean, look, not to make too much of this, but there's been financial advisors commit suicide, right, because they couldn't cope with the speed and the level of change that the government put us under. So there's actually a really damaging side to this that nobody wants to go back there. So in terms of that educational standard and making sure that the people understand, well, now we've gone from what's called an occupation to on the journey to becoming a profession. I don't know if that's something you've heard that phrase before. And so, the calling of a profession is to say, how do we give back to the community? How do we make sure that what we're doing actually benefits people? Right? So, which is very different to, say what a Finfluencer does or what even advisors would have done 10 years ago. So sorry if it's a long-winded answer, but yeah, I don't think anyone's going to want to go back to the old days very quickly. All right. So, but there's all these conflicting things like, okay, what does good advice look like? Does it have to be an 80-page document?
Yes, that's right.
All right.
That's right.
So, what does scalable advice look like?
And even from the point of view, a 24-year-old doesn't want an 80-page document.
No.
Yeah, they don't want to pay for it. They don't want it. They don't want to read it. So it's about going, where's the market for that? And currently there isn't a market for that, and hence why the Finfluencer phenomenon was able to actually, take off. But look, moving away from Finfluencers and going back to your study, when these Australians, the average Australians during COVID started dipping their feet, into this market, all of the retail volume, went up by how much
Yeah, more than 50%.
More than 50%.
Yeah.
Did Australians make money? Did they lose money? I mean, what happened there? You know, the market was obviously rising. So like you said, anyone who did a half decent trade was probably going to do okay during that, 2020.
Yeah.
But what were the results in the end?
So that's actually a good point because even before the pandemic, there's already various research in the States and also in Australia that shows that retail investors are actually not that good if they choose to day trade. On average, they're going to lose money, which is not surprising because they're not professional investors. So this only shows that during the pandemic, because of the magnified trading volume by retail investors, any losses would be magnified as a result. So my study actually shows that this is actually the case. Right? So what I did is that I actually classify stocks into stocks that most retail investors bought and into stocks that not many retail investors are interested. And I look at their return over the next 10 days. So this will give an indication of how much you would be able to earn if you choose to trade in a short period of time. So I actually find that if you actually build your portfolio based on stocks that most retail investors bought, you are actually going to lose 7% just over the next 10 days. So this actually shows the danger of trading intraday trading, meaning that on average, even though we know that if we hold it over a longer period during that year of 2020, you would benefit. But if you choose to day trade, right, so there's an average loss of 7% if you buy stocks that most other retail investors bought as well. Right, so if you look at the other spectrum, whereby those contain the stocks that not many retail investors are interested in. So this portfolio of stock actually generated a positive return of 7%. So again, it shows that retail investors, if they choose to day trade, they actually don't have the skill to pick the right stock because stocks that they pick generated negative return over 10-day period and stocks that they don't like actually generated a positive return over the same period of 10 days.
So, Mardy, can I quote you from now on that if you take on a financial advisor, that your return will jump by 14%?
So if you could
very careful what you say here now, Mardy.
So that's what my research shows. If you could day trade over that short period of 10 days, right? So this is what would potentially happen. But as you all know, right? So you will all have this disclaimer as well. Past performance is not an indication of future performance.
So look, here's a question I wanted to ask you, and actually for both of you, this would be a good question. I think the average person, the average retail trader, actually doesn't know what a professional trader does, what they actually go into. Can you give us a bit of insight, the difference between, say, a retail trader who reads something in the paper, sees a Finfluencer, or, Uncle Bob says, I reckon BHP is going to do well. Do you know, what's the difference between that compared to what a professional actually does do?
Do you want me to go first or would you like to?
Yeah, maybe.
Yeah, okay. So I think the first thing is that what most professional investors are doing is they're actually looking at each individual company that they're trading in and saying, okay, what's my strategy here? All right, so you'll get phrases that investors will use like, I'm more interested in income, all right, and I'll buy companies based on the evaluation method, all right, and then you'll get other investors that will talk about, I don't really need income, or I don't believe that this current season is suitable for a valuation method. I want to go with a growth method. All right. So, and both are, without sort of going too far down this rabbit hole, both have very different philosophies for different points of time. So 10 years ago, all right, if you sat down and said, I believe in a growth method, you would have gotten it right and you would have been quite successful. All right. So, the challenge is in this next 10 years, does it suit more of a growth orientation, or should people be looking at more of a valuation or a value methodology. All right. So, and I just can't explain those concepts in.
No, but I guess what I'm trying to get to as well, though, is even the fact that people understand there are actually theories around this. There's a thought process around it that one professional compared to another, or one company compared to another, will actually decide that is the way we're going to move forward. And then behind that is all the research, and computer programs and simulations and whatever else that goes into actually making them decide where that is. I mean, even something as simple as going, you made that comment, they evaluate the business. An average retailer, the average mum and dad can't evaluate a business.
Yep.
I mean, what are the sort of things they're looking at when they evaluate a business?
So I guess so for an average mom and dad investor, they probably would buy stocks that receive greater spotlight by the media, for example.
Yes.
So there's also, I guess, number of research that shows that mom and dad or retail investors, they tend to like to buy stocks that are close to their 52-week high. Because this is something that's quite accessible through, let's say, Yahoo Finance. So, but we know that past prices is probably not an indication of how the future price would be. So there'll be like, I guess, more this for retail investors. They are probably going to base their trading base on feeling or hunch a lot more compared
to what they've read.
What they've read. That's right. And they probably have this simplified version of what's a good stock and what's a bad stock. So there's just two categories of good or bad. But even though, right, so for professional investors, there'll be like a spectrum of, let's say, 1 to 10. If you look at the spectrum from good to bad, right? So it's not it's not a two category only for professional investors. And as Hamish mentioned, right, so professional investors do talk about those various trading strategies, and there'll be a lot of research and back testing that's done. Right, so Hamish mentioned about the difference between value strategy versus growth strategies, and there's also some other strategies like, let's say, evaluating company structure in terms of the quality of the business, whether that's a good business overall based on a composite measure of different aspects of qualities. And of course, there's also some professional investors, for example, who might prefer to have exposure to small stocks or large stocks, or let's say momentum trading. So all these actually require a lot of research and back testing that probably a typical retail investors do not have the resources or they are not built to develop those skills and trade based on those skills.
So I guess moving forward, Hamish, I'm a retail investor. I'm an average mum and dad. I want to invest in the stock market. I've been listening to Mardy, and I don't want to lose 7%, let alone have a 14% difference. So I want to invest, but I don't know where I go from here. So tell us, what is the best way forward for the average person to invest their savings in the stock market?
So I guess the first thing is to ascertain whether this is the right time for you, because any strategy you put in place usually requires a commitment over time. Yep. So if you just said to me, I've got 10 grand, but I need it back in 12 months' time, what should I do with it? Well, the reality is that's a very hard thing to say. It's appropriate to do that right now. But if you're in a position where you've got reasonable cash flow and you're ready to invest, let's make that assumption. Then the first thing we would do is, and Mardy mentioned this before, we try and measure your appetite for risk, all right? And whether you're more focused on or whether what is best for you is growth or income. All right. So, and for a lot of people, it's a mix of both. But sometimes, retirees typically are more focused on income. Younger people, you become a little bit more focused on growth. All right. So, as a stereotype. So then you've got to get that mix right. So it's thinking, okay, do we just want to invest in Australia? Do we want to invest something overseas? Do we want to invest, and so for us, we're trying to put together, I call it a strategy that has this mix. All right. So, and we'll hear this word diversification get bandied around, but, whether you call it a mix or a diversified, portfolio, it's trying to get something that has a range so that if the market drops, that you're not all in one space. All right. So
am I doing that? Am I choosing the companies or are you using managed funds, or what are you actually doing to
it can
put
be
that money? Like $10,000,
Yep.
I'm happy to leave it there for 10 years. I'm average risk taker. You know, where do you sort of go with that?
So, I mean, we probably tend to use managed funds more than shares, right? But I'm licensed to do direct shares, but you'll probably find that there are stockbrokers or other types of advisors that might be more suitable if you want a direct share strategy. You know, typically what I say to people is you just have to appreciate that a direct share strategy needs you to really sit behind the wheel, because you're going to be asked to make all of the major decisions. Whereas a managed fund is more set up for you to be able to go, all right, I don't want to make all those decisions because I'll probably be more like a retail investor and I'll get them all wrong. All right, so set me up with something where other people are doing a lot of the grunt work for me, and all I have to do is commit and continue with the strategy.
So I think a lot of people's fear is that there's a high cost involved in that. They hear professionals, they hear all this research, they hear all this stuff. They go, here's my $10,000. I'm putting it in a managed fund. I mean, you know, from a cost versus reward ratio, what sort of happens for the average person?
So, yeah, look, I mean, you know, at the end of the day, the first start of is you need the education. So you might feel like it's a little bit expensive to start off with because you don't know what you're doing. All right. So, but the logic is that if you put the right strategy in place and you've got the right time frame and you allocate that initial cost over the length of the investment, then it should become affordable if the advisor is doing the right thing by you. All right. You know, and again, there is some economies of scale, you know, the bigger you go, right? And that's the problem with advice at the moment. You know, but, you know, long term, what I expect to see is models come out where it does bring the cost down, hopefully, especially with this review coming out, that they will allow for, investments to be put in place for lower values that don't have the same cost as what they do today.
Because there's not as much oversight required for them.
Well, yes. Like I know that ASIC at one point in time talked about there should be a different set of rules if the amount to be invested is under $10,000 versus over $10,000. Yeah. But that rule's sort of been lost in all of the post-Royal Commission, you know, stuff that's been going on. Yeah. So yeah, there should be, I believe there should be, you know, a subset of rules that says if you're only investing this much, it's a lower risk. We don't have to have the complexity that we do if you're investing a much higher amount of money.
Yeah, 100%.
So yeah, the managed funds, I think, suit more retail investors simply because it takes a lot of that emotion and that risk of individual behaviour mucking up the portfolio. Would you agree with that, Mardy?
Yes, so I think I do agree with you, Hamish, and this is also shown in prior research that if you, as a retail investor, if you don't know what or how to start, it's probably best to start with something that follows the market, managed fund. Yeah, because it will be far more difficult to perform stock picking because most people or most mom and dads would not have this skill to begin with. So instead of, I guess, trying to develop a strategy that aim to outperform the index or the market, so probably the best return that you can get is the market rate of return by mimicking or following the benchmark. So that probably can be a great starting point, as Hamish mentioned. So creating this or following those managed funds with diversified portfolio of stocks that try to mimic rather than beat the market performance.
Absolutely.
And also, I guess I also want to add that this also goes into the difference between active and passive trading. Right? So I think Hamish might have mentioned as well, if we trade more, right, so the transaction cost might become quite significant, which is also why, right, so probably, right, so this is shown by research as well, right, so over the long time, a more passive trading strategy that mimics the market benchmark is probably the best starting point as we gain more and more financial literacy or trading skill. That's when we can then start to maybe perhaps consider some of the active stock selection skill in order to complement our passive managed fund portfolio.
Great. Well, look, I'm going to whiplash you a little bit and take you back to the beginning of the podcast. So in wrapping up what we've been talking about, we started off talking about gambling, and I wanted to ask you, with all of your research and all of what you've been doing, do you think that, there's a big call for more regulations around gambling. Then there's the other call for more education around gambling. Do you think that it's either or it's sort of both?
Yeah, so I think, of course, right. So if the sole purpose is to reduce gambling loss or addictive gambling problem among Australians, of course, there's things that government can do in terms of interventions, right? So, for example, making it more difficult to access those gambling opportunities, right? Or having, like, let's say, treating addictive gambling as a public health problem, whereby there'll be like counseling services available for people who face those over gambling problem. So, but at the same time, I guess for us, right? So as individuals, it is also important for us to understand about the problem associated with gambling. Right? So it is fine. So if you think of gambling as a fun and exciting hobby, so of course, right? So you can do that as part of your hobby as long as you can manage it. Right, so the problem is addictive or over gambling, whereby we're actually over gambling to the extent that it actually costs us our life saving, or it actually put us in a really bad financial position that we can't actually pay our debt obligations due to over gambling. Mm-hmm. Right, so for me personally, so I've mentioned earlier as well that I know that gambling on average comes with a negative expected payoff. So this is why personally gambling is not something that I would do as an academic in finance. And second, I don't find gambling as a fun and exciting activity myself. So that's probably not something that I'll be able to do. Right. So of course, I'm not saying that we should not gamble. Right. So I'm just saying that if you think of it as a fun activity, think about it from your own personal perspective about how it can be affordable, or how gambling spendings actually fits within your budget as a hobby.
Mm. And if I can add to that, I totally agree. And I think probably from what I hear, one of the biggest mistakes that we can make is we call something an investment, but it's not an investment, it's a lifestyle decision. Right? So we call something an income-generating activity like gambling. It's really a lifestyle activity. All right. So having that ability to really categorize it properly, and to an extent, for most of us, don't kid yourself. That's really what it comes down to.
Yeah, fantastic. Well, look, I've really enjoyed having you. Thank you so much for coming and talking to us about gambling, talking about the share market and trading, what happened during COVID, and even dipping our toes into Finfluences as well. We've covered a lot of topics today, but I really appreciate you coming along. So thank you so much for coming.
Yeah, thanks, Marty. Appreciate
it. Pleasure to be here.
Now, we do have a question we do ask all of our guests. So 2 questions. Firstly, what would you tell your 18-year-old self if you could go back and sit down with him? What would you say?
Yeah, so that's a good question because so 18, when I was 18, that's probably the time when I was kind of trying to be a perfectionist, whereby I want everything to work out the way that I want. Yes. So, and then of course, as we grow older, we start to realize that that's not going to happen. Right? So we don't get all the big wins in life. So this is why I'll probably tell my 18 years old self to be kind to myself. Yep. Right, and to trust that every one of us will have our own unique path, right? So to succeed, so there's no one set path, and there's no one set way to be successful or to be happy in life. Yes. Right, and I'll also probably tell myself that don't worry too much, just live at the present and believe that everything will work out at the end, one way or another. Right. So of course, right. So it comes. So you need to, I guess, be motivated, and you also need to know what your ultimate life goal is at the end. Right. So of course, right. So ultimately, right. So we want to work towards a certain goal, but what's also important is that we also should enjoy the journey. Yes. So life is not about what's at the end only. So the journey towards that goal or that path is also something that we should all enjoy.
Fantastic answer. And the other question is, if you were going to write a book, what would it be on and what would the title be?
Okay, I'm going to start to sound like a boring academic, right? So as Steve mentioned earlier, I've written over 20 academic articles. So probably writing a book is not my big agenda now, right? But if I do want to write a book as a plain boring academic, it is actually my dream to write a widely used textbook on investment that many uni students actually use. So I want to be in a position where, let's say, if I meet someone 20 years from now, that fella or that person is going to tell me, "Oh, hi Mardy. So I've read your textbook 20 years ago when I was back at uni, and I find it really useful." So that's, I guess, my dream as a plain, boring academic.
So hang on, so to do that, you're going to have a catchy title, because it can't just be, the market. Like, what are you going to call it?
So it's probably going to be like, let's say, fundamentals of investment, or I guess a behavioral aspect in investment, or something like that. So it'll be something about finance, stock market, and investment.
Yeah, I've got to say though, Mardy, like listening to you tonight, I would almost expect the title of the book to be "Don't Do It."
Leave it to the professionals.
Or maybe then in small print down the bottom, "Unless you read my book."
Well, look, thank you so much for coming. Really appreciate your time, and I'm sure we'll talk again at some point in the future.
Yeah. Thanks again for having me.
Mardy.
And everyone out there as well, all the listeners, thank you so much for tuning in. As always, Help My Wealth and Money Rules. Money Rules is all about empowering your financial journey. I hope that's been helped today when we've talked to Dr. Mardy Chiah and talked about gambling, finances, the share market, Finfluences, and everything else. So bye, and we'll talk to you next time. Thank you.
Thank you.
The information discussed by the Help My Wealth and the Money Rules podcast is for education and entertainment purposes only, and is general in nature, and it is not advice. It is not intended as a substitute for professional finance, legal or tax advice. It is aimed to provide a general understanding of each topic and should not be relied upon to make an investment or financial decision. It is strongly suggested that you seek professional advice regarding your own individual circumstances before making a financial decision. Help My Wealth and the hosts of the Money Rules and Money Rules podcast are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. In the spirit of reconciliation, Help My Wealth and the Money Rules or Money Rules podcasts acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to past, present and emerging elders. We extend that respect to all Aboriginal and Torres Strait Islander people today.